You talk about $50,000 or up to $50,000 in net rental income after mortgage, and at a cost of about say million one, you're looking at almost like 4% net yield after mortgage. That's like almost, from my calculation and being a data scientist, that's almost like 18 to 20% cash on cash returns, right? If you're basically getting them at around say 80% LVR. Great, awesome. I think sits right at the top. Let's look at the downside, right? So you are assuming 100% tenancy in these. You're assuming that there are 9 tenants there from day one. As soon as you open the door, as soon as the builder finishes this, you open the door and you have 9 people marching right now occupying these from day one. What is the possibility of that, and how do you ensure and guarantee that these rooms would be filled by 9 people or even 6 people in certain cases? You're listening to Help Me Buy Property podcast, powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to student investors. Connect now to experience it yourself, or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing. Hello and welcome to Help Me Buy Property podcast. This is part 2 of our insightful discussion revolving around co-living spaces with the dynamic Mr. Rajan Sharma. Now, with the rise of this popular property investment strategy, it's easy to say that you can get caught up into the hype quite quickly. So what's happening behind the scenes is what we are going to actually talk about today. What are the pros and the cons of rooming houses in a lot more detail, from council approvals to builder's risk. We'll separate facts from fiction today. We'll give you the inside scoop of what takes to succeed in co-living investments. So without further ado, let's begin. For your own benefits, stick till the very end and enjoy the show. Let's talk about the pros first in relation to the 6-bedroom, 6-bathroom.
All right. I think some of the marketing is correct to start with. So if someone is saying that they can generate a good cash flow, I would definitely agree with that. It's a simple calculation that, and again, I am actually a bit afraid on generalizing it because there are too many products and too much happening out there in the industry with different ways they are building it. But from a conceptual level, if it's built right, you can actually get anywhere between, let's say as a ballpark, 300 to 320, 330 per week per room. And it actually takes you to the gross 93,000 number. Again, bear in mind, definitely as a landlord, you have to pay the electricity bill, the water bill, the cleaning and mowing. The insurances are a bit higher. So just remember that as well. And then Moss mentioned that the property management fees also sits around anywhere between 12 to 15%. So basically, if we talk about net, you are looking at around anywhere between $25,000 to $30,000. So
my understanding also is that when you talk about the 6-bedroom, 6-bathroom, typically, because they are almost like single self-contained units, so you can safely identify how much is the electricity or the gas or the water usage per room. And if you can measure it, you can definitely pass those costs back to the client. Is that something that is true, or this is something that is unheard of?
No. You're not passing anything back to the tenants who are living over there. If you're doing that, I don't think so. You'll be getting even close to 300 per week, and that's where 100%. And again, I'm talking about the ideal here. As Moss mentioned, there are a lot of stuff happening in the co-living space. But if you're with the right player doing the right thing, almost 100% of them will have this ecosystem wherein all the outgoings, including the water bill, electricity bill, your cleaning, mowing, everything you need to pay as a landlord and furnishing as well. But still, after all those outgoings, because we are talking about 6 bedroom, 6 bathroom, we are talking about a gross touching above $90,000, you still are sitting in this time and era, I'm talking about, at a good net cash flow return after tax. So yeah.
And so on a 6 bedroom, 6 bathroom, that is the return that you're talking about. So this is net return that you're referring to?
Yeah. So if I talk about net return, and post tax, again, you're looking at anywhere between $25,000 to $30,000 in your account after paying your mortgage. So that's a net definition. It's not just the net parting away with the outgoings, essentially.
Okay, awesome.
Yeah.
And
so it's everything you're paid. Yeah.
What about a typical return for a 9 bedroom, 9 bathroom? So you've talked about the good side, and before we start getting into the ugly and the bad side and start doing the postmortem, let's look at the returns for the 9 bedroom, 9 bathroom as well. What are we talking about?
Yeah, it's one of our flagship products, by the way. Not everyone can do it, and everyone is doing it. And I take pride in saying that even if some players are doing it, you will find that the turnaround times are crossing 20 months. I can confidently say that out loud, that we are one of the fastest. So enough about us. So let's talk about 9 bedroom, 9 bathroom returns. So
how much are we walking away when we talk about the returns?
Yeah. I'll start with gross though. Again, 140K per year is the gross we are talking about. And if you talk about net, you are actually looking at anywhere between $45,000 to $50,000. When we deep dive, please be there connected in the whole podcast, because we will be actually talking about how that $50,000 in 3 to 5 years can become $80,000 as well.
So all the good side is great. I think you're talking about $50,000 or up to $50,000 in net rental income after mortgage, and at a cost of about say $1 million, you're looking at almost like 4% net yield after mortgage. That's like almost, from my calculation and being a data scientist, that's almost like 18 to 20% cash on cash returns, right? If you're basically getting them at around say 80% LVR. Great, awesome. I think sits right at the top. But let's look at the downside, right? So you are assuming 100% tenancy in these. You're assuming that there are 9 tenants there from day one. As soon as you open the door, as soon as the builder finishes this, you open the door and you have 9 people march in right now occupying these from day one. What is the possibility of that, and how do you ensure and guarantee that these rooms would be filled by 9 people or even 6 people in certain cases?
Right. So now I will be specific because I don't know what logics and what kind of efforts are done by the other players to converge on where they are building the co-living houses. If you pick up any of our 9 bedroom, 9 bathroom house, you will find the proximity is really, really very, very close to the universities, to the hospitals, and the infrastructure, which supports almost 95% to 100% occupancy. If you talk about whether the tenants will march in, to your question, so there is a science behind it, which is, and I will not say science, but rules behind it. So the rules which we need to adhere to are, and especially for a 9 by 9, and I'm talking about Victoria specific, like I mentioned, the magical number is 3. So what really happens at occupancy is that there's an element of furnishing which happens, which can be done proactively in a lot of cases. But having said that, you can only get 3 tenants legally again, and you can provide them the tenancy agreements. Now, what happens right after occupancy is that we help you registering that house as a rooming house with the council. You become the rooming house operator, and then there's a rooming house manager there who will be managing the house for you. And once you get that rooming house registration for that 9 bedroom, 9 bathroom house, then you can get the remaining 6. Intelligent property management agencies, what they do, they preempt it, and in anticipation, they do their marketing in a way that when you get the rooming house registration, which takes like approximately 1 to 3 weeks, you actually put the dates of them moving in your marketing, and then when you are actually talking to them, essentially. So to answer to your question, the experience we have, for the first year, it will be around 95%. And from the next year onwards, it will be 98%. For the first year, because there's still that movement going on, that's why it goes a notch down. And again, I'm specifically talking about where we are building our co-living houses, because there's a lot of effort which goes into when we are converging on the suburb, on the right suburb for you, and not just the right suburb in terms of the vacancy rates and how many people are looking for rooming houses and so on and so forth, but also where the land is located.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in their property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. Sure. So you are saying basically that exactly how many roaming houses are there in a particular suburb, how many people are looking for rooms in that suburb, and how many people have already found rooms. So it's like you have live data available to you to basically make those evidence-based decisions.
Yes, 100%. And we look at a lot more because we are powered by a company which actually lives and breathes data. So apart from all the other data analysis, these two parameters are really, really mandatory for us to converge on a suburb. And then just to close the loop, the proximity plays a big kind of, it's a very big contributor on where we are building it. Yeah.
Now, so of course, the follow-up question then becomes, especially for people who are doing it in Brisbane, right? Where you cannot do co-living properties outside BCC, and majority of the stuff happens within Brisbane City Council because it attracts infrastructure charges outside BCC. How many can you build within BCC? Are you not like saturating the market? Like this is like you build 10 on one street or 20 in a suburb, and would you not be competing against one another? And how many can you sustain? Do you have any data supporting that?
Yeah, so again, I mean, that's why we have this strategic decision that we are not entering Brisbane because of these two reasons. One, because you can't actually segregate it to ensure the fulfillment. The other thing is that you're absolutely right. I mean, the oversaturation is happening. And if someone pushes us to build it, you need to also understand that the land costs will be super high. One. Secondly, it will be almost impossible to find a land which is like ticking all the boxes. You will be going in field and you'll be looking at existing houses. So if we talk about the overall acquisition cost, you're better than me in maths, but it might actually match your 9-bedroom, 9-bathroom in Victoria. And you can't expect, and to reach that level of the cash flow of 9x9, you might need to get like $500 a week per room, which is almost impossible. And I often get like stunned by seeing people putting out numbers like $400 per week and $450 a week out of thin air. So yeah.
Yeah. And I mean, how much of this is council driven, right? Because of course, council would play a big part in approving these. And I know in BCC, it becomes quite tricky because you have to go and get the planning approval in place, especially if you're doing a duplex. And so there is a very clickbait sort of strategy or bait and switch strategy where you build it to a duplex and then you convert it into a co-living. And so what role does council play and how do you ensure that these are completed on time? Because naturally I've been hearing horror stories, right? I've heard stories where people have been waiting for 12 months and 18 months before even the build kicks off, right? There are players out there who have gone through, who have put even some of my clients that I know that I've referred to some of these players who have gone through that pain, right? So like how do you control that side? Of course, no one can control council, right?
Yeah, I mean that's like one of the things which is close to my heart, and obviously you've sent me some of those clients. But being in the co-living space since long, I have seen these things happening wherein, like you said, duplex was one of the examples. I mean, people play those games like will build a class 1A and then convert that into class 1B later on, and I've seen a lot of suffering. I don't find a better word than that, wherein the council turns back and says, we are not giving you the rooming house registration. And then you take that pain of 6 months or so fighting with the council, paying through your own pocket to a lawyer, and then getting that registration through. What we do is, and that's why I often hear it's too good to be true or a watertight process. So we spent like months and months and months based on the experience we had and first-hand experience we had in regards to the client's own experiences, our experience, and looking at every single gap. So I think if someone from IT is hearing it, it's a lot of gap analysis and risk analysis was done at a microscopic level. I would like to emphasize on that. And how we do it is that we ensure that you are safe at every single point. So what I mean by that is, and I'll give like a couple of examples here, but what I mean by that is that we ensure that before we let you go unconditional on any property, may it be an existing house or a land, we ensure that we get a written planning advice from the council so that there is no ambiguity. And again, taking pride in that is...
So how does that work? Because I know that even architects take like freaking 4 weeks to even divvy up a plan, right? So how can you guarantee that if I have a 4 weeks finance clause, that not only that the architect is basically providing me with the plans, the council is basically providing a planning advice as well. And I know horror stories in relation to Victoria where it's taken 6 months, 8 months for people to seek planning advice, or Brisbane, very similar. How do you go around like guaranteeing it?
On a lighter note, I always used to actually demean the finance guys that your closing never happens. You're always like stressed out all the time. Why can't you preempt the deadline, right? Which is obviously not possible. Similar story with us. We have a big team of specialists ensuring that even the full-time architects we have in-house, they also have it called out on their contracts that there's a 24-hour SLA for them to ensure that...
Do you have an architect within your business? Is that what you said?
We had to do that, Mox. Like we didn't have any choice because we did work with agencies and on contracts, but we figured it out pretty quickly and pretty early that we want someone, though obviously it was a huge business expense, and obviously we had to get someone really experienced in the class 1B space.
Yeah, architects are not cheap. Like, look, as a developer, I know that architects can cost somewhere between $150,000 to $200,000 a year. So, yeah, wow, okay. And so that's interesting. And so, okay, so that side is covered. So you have someone in-house, and so you're basically pushing your timelines through architect. So, of course, if an architect sits outside as a consultant, they might take 2-3 weeks because they're managing multiple people. But even your in-house architect, he would still take time drawing up plans and doing all of that, right? So, yeah.
I'm not sure whether I should reveal the secret sauce here in the podcast, but I think for everyone's peace of mind, whoever is coming and thinking of coming and as a client of ours, we have our master plans ready, basically. So what I mean by master plans is that we have a master plan of a 9-bedroom, 9-bathroom, in fact, multiple plans, because they have been optimized more and more. What we really do is once we acquire the land, and again, there's another big element into it is the land acquisition team and a lot of validations which happen. May it be you're talking about your bushfire, flood zones and heritage zones, which is like quite normal, but looking at the overlays, looking at the slope. And our architect again looks at all the covenants which can stop you from building a sharing house. So after all those validations, what really happens, Moss, is that our architect then fits in our master plans on that land, and that land is specifically chosen. The land is chosen validated by architect himself, right? So he already knows that they'll fit in.
This is very interesting because majority of the players that I've seen out there, either they're using experienced buyers agents or they are calling out on their own decade or industry experience of them doing roaming houses. And so even they don't have in-house architects, which is quite interesting. And so talk to me a bit about the council side of things. So council would, of course, take a lot of time. Council is not, you can't hire a council to do the job. So how do you ensure that the council responds back? Have you done some pre-work? Have you tested some of these master plans that you're talking about? How does that work?
I think if I go back to when I mentioned about you spending that blood and sweat and money as well in testing out the whole process, and then only you can make any process watertight, right? You have to experience it. So yes, to your question, definitely a big yes, that we tested ourselves first in multiple councils on how the process works, how much time it takes, and what we exactly want from them. And that is what has made us really successful, and really we're aggressively growing so fast. The main reason behind it is that the whole process end to end is all tested and vetted and validated. How it happens, and of course, to answer to your question that you can't hire the council guys, of course not. It's all about how proactive you are and what's your turnaround time in pushing or submitting that application to the council and following up with the council through and through. One thing which I want to call out, that we take it, and I always say, I mean, I don't know if this is a pretty strong word, but we take it head on with the council. What it really means is that we don't play those games of it being a residential play. All our designs which get submitted to the council are sharing house designs. And based on that, only we get the planning advice. Now, I'll not, and again, because there's a council element in it, not just talking about the picture perfect scenarios. I mean, there are cases wherein the council delays things. But again, why it's a watertight process? Because then what happens is that we file for extensions, and we often get it for the finance clause. But the important part to understand here is that we will not push you or throw you and make you acquire the land before we get the council planning advice, and we are at that complete piece that there'll be no ambiguity looking forward. So I think in a couple of cases, the council has taken 4 to 6 weeks. There are councils who turn back and gives you the advice in like 1.5 weeks or so. But the important part is that we'll not let you go unconditional unless and until we have that written from the council. So you are safe. Your deposit is safe. Even if you talk about worst case scenario, I mean, we'll go for another land and another council. If at all we are not able to push through. But it'll never happen that you're through.
Typically what you're saying is, sorry, I'm cutting you off. So typically what you're saying is that if the council does not approve, if the council has an RFI, you typically walk away from the deal, or you walk away from even after all these due diligence that you have done up front with the architect and with all the consultants that you have.
I would not say that we'll just walk away quietly. We will definitely answer those RFIs. If it takes time, we'll file for extensions on the other end, keeping you safe. We have spent our own money on lawyers as well, by the way, to opening up the rooming houses when council did reject one of the applications. And finally, it got through, and then we are building 5 over there now. So we will walk away only in that kind of condition, and walking away from the land I'm talking about, not walking away from the council per se. Because if I had to deep dive a tiny bit into that kind of a scenario, which we have not come across yet, which is that we had to walk away from a particular council based on they delayed and they were putting in a lot of RFIs and there was a lot of pressure of the finance clause. I think in that scenario, what I can assure you we'll do, not even what I'm thinking we'll do, would be that we'll definitely pull out so that the client is not at risk at all. And we will continue our conversations with the council to understand where we are missing the point or they are missing the point, and eventually get the planning advice, even if we have walked away from that particular land. But what it does for us is that it opens up the other lands which are available there. So sure. That's what we'll be doing. Yeah.
Interesting. And so following up from the council, I understand all of that. I understand the tenancy side of things. Let's talk about the builders. Like, you're going towards the build. One of the biggest risks that is there right now is builders going bust, right? And so typically how I see you or other people operating is that you are just a glorified house and land package seller, right? Like, that's how I see a lot of these people, right? You know,
okay.
They call themselves co-living experts. They call themselves whatever.
Yeah.
But you are just a glorified sales agent, right? So how do you control the builder?
without taking offense, by the way. But house and land, if I had to compare the complexity, I would not shy away by saying that it might be 100x more complex than what we do, by the way. We're not actually buying a land and building a normal house in which you only need to care about which colors or what type of facade it would be. It's more technical than that. You need to ensure all these houses are class 1B. It's not a class 1A normal residential. So you need to understand that you either have double walls or acoustics, basically to ensure that there's enough soundproofing. And that's just one part of it. There are multiple parts to build a class 1B. Now, just to kind of elaborate a little bit more, a normal builder who is building a normal house and land package cannot build a class 1B. You need to have specialized builders. And when we get into details, we'll talk about nitty-gritties of even having a disability accessible ensuite for these houses. That's again another element. Now coming back to the builders.
How do you ensure the builders? Like, how do you control the builders?
So what we have done deliberately as a strategic call, that since one of the arms of our business is development, and we will do a lot of this, $17-18 million every year, we have not gone out of our ecosystem, so to speak. So the builders who will be building your house are our own development builders with whom we have a working relationship of more than 20 years. They themselves have experience of more than 30 years. So number one, I mean, if a builder is a development grade builder or a development builder, the first thing they take care of is their margins. They're always building high risk value propositions like 5 townhouses on a big land and so on and so forth. But they are also covered with a domestic building insurance, right? If they go bust. Every single contract which is provided to you is a standard HIA contract, which safeguards both the builder and you, but there are insurances in place if the builder goes bust. But just to give you that peace of mind, we're talking about experience here, and that to more than 3 decades. So we're not talking about that we went out with a tender and whoever gave us the cheapest quote to build, we accepted that. So that's what we need to remember. And they're not cheap. They are expensive, but they bring in that quality as well and that comfort as well of not going bust like a mom and dad builder who is just building house and land packages.
Sure. Now, I've seen a lot of people, they charge an arm and a leg before you even get to the build stage, right? My experience has been that some of the players charge between $30,000 to $70,000 in project management before you even get to signing the building stage or taking through all of these, dealing with the council, dealing with the consultants, etc. So again, I keep saying that and that's why I say that they're glorified house and land experts and salespeople, right? So is that a norm in the industry? Is that what everyone does? People charge between $30,000 and $70,000 in project management?
Yeah, well, it depends. That range which you talked about, we don't do that, by the way. Just calling out loud.
Sure. What do you charge?
Then
you charge nothing?
Sorry?
You charge nothing?
Whatever we charge, we actually spend on you, and I'll explain further why and how. But if you talk about the dollar value between $30,000 and $70,000, it's just one aspect when you talk about a dollar number. But the pain is much bigger than that. And the pain is, and again, everyone feel free to call all the co-living players and ask about their processes, please. You will find some of the players who will be charging you anywhere between, like Moss mentioned, $30,000 to $70,000. And it might be a waiting period of 6 months, 8 months as well. Now, what happens there is, and I have kind of validated it myself, and it's fact, and if you get on a call, you will hear exactly same answer, that you bring the land, we'll build on it, and then these charges are essentially for the planning permits and so on and so forth, and town planning, I would say. Just try asking them, what's the surety? After 6 months, it'll all be approved. No one knows. You might still get rejected. It might go down the drain. And that's where I got stunned when I actually got that answer, which means that even we are talking about this $30,000 and $70,000, there's no surety there, right?
Sure.
The things can fall off. So it's
and is it because they don't have an architect, or they don't have the builder, or they don't have the tight process, or is it just inexperience, or is it just mere stupidity?
I think a combination of all. Sure. So, see, yes, definitely. I mean, processes plays a big part into it. Understanding the end-to-end ecosystem and how you can think out of the box and circumvent that is an essential part of it. Maybe they're used to doing it in a certain way and they keep on doing the certain way. They think that it has to be done in that way. Maybe the clients are also explained. So I think it's a combination of all, wherein they've not thought about how it can be done faster, how it can be done without risking the hard-earned money, which is $30,000 to $70,000 of the client. If you ask about my process, let me call it out that if at all the finance fails, right? And again, it's like way low, a drop in an ocean if you compare $70,000, which we charge, but that's completely refundable. If the client is not able to go unconditional, we refund it, right? So, and that turnaround time we are talking about, if you add in that $70,000 and those number of months in the whole turnaround time, you're actually talking about 100% more time. You in certain cases, you're like Moss, you just mentioned, right? It might take 2 years before which you get your co-living house. And it doesn't just mean that, all right, okay, another year, but you are actually paying for the land you acquired initially, waiting for it for 6 months, you're paying for the land, and then the bill starts, you're paying for that. So you can combine all those costs. It will be really, really, really bad in regards to the total dollar number you'll be parting away with. Maybe 30 to 70,000 even fall short in regards to the total turnaround time, pain, and the progressive payments and interest rates.
Definitely. Let's take a very quick break here, and we are going to join you right back. When we come back, we are going to talk about valuations. We are going to talk about fulfillments. We are going to talk about property management. These are some of the important questions, and equity, like putting in so much money into the deal, and what does that really, really mean? And we are going to talk about competition. We are going to talk about what does that mean in relation to single people, and we are going to also compare this to NDIS. So stay tuned and join us back very shortly. This discussion doesn't end here. We still have a lot more to cover. In the upcoming episode, we are going to talk about the valuations, the most talked about the topic when it comes to co-living properties. We're going to talk about fulfillments. We're going to talk about property management. These are some of the most important questions, and even like equity. Putting in so much money into the deal, and what does that really mean? How does it really come out? We are going to talk about the competition. We are going to talk about what does it mean in relation to single people. We're going to compare this to the drumroll NDIS. Is rooming houses investments really worth it, or is it just a fad? Let's find out in the next episode. Till then, keep investing, keep smiling, take care, stay safe. This is Moss checking out. Adios.